People are end up paying 47% tax on their trust income. Obviously, nobody likes to pay that extra 22%.
Really want to start by addressing the elephant in the room, the budget. Maulik, please help us and help us understand what's going on with the budget, the negative gearing and everything.
Negative gearing for existing property is gone. With the trust now, there's a minimum 30% tax. You have to rework your strategy. You try to rush into scenario and you say, hey, I'm going to change the structure. If you change structure, if your property within your family trust, then you end up paying double stamp duty.
What are the goods according to you that you have seen from the budget?
So it's pretty good for those people who's looking to buy their first home. Basically, you got two options. You get a smart accountant or pack your bags and go.
After all the discussions around budget, including negative gearing, capital gains tax, this end of financial year around the corner, there is the sentiment around property in the market, there is honestly no shortage of conversations around tax, lending, property, superannuation, and wealth strategy. So today on Level Up with Priyanka Shah, we have not one but two experts from their fields. We've got Maulik Shah, who's an expert accountant, and Hardik Shah, who's a mortgage broker, and we'll be diving straight into all things budgets, tax, property, lending, and anything that matters to Australians building wealth. Maulik, bye Hardik. Thank you so much for joining us today. Very excited to talk about all things budget, property, end of financial year. So I think really want to start by addressing the elephant in the room, the budget. Maulik, please help us and help us understand what's going on with the budget, the negative gearing and everything.
So I think budget has made a lot of changes. It's they have stopped negative gearing after a few decades. Almost 50% discount got introduced sometime in 90s, and then since then the formula was decided. Negative gearing was going on, but now in this budget they've changed lots of landscapes. Negative gearing for existing property is gone. With the trust now there's a minimum 30% tax.
Right.
So basically, you have to rework your strategy in terms of investment cycle, where you're gonna invest in future, where you want to get tax benefit or not. It's all about those things. You have to rework your strategy and work out, see which way it's beneficial going forward. So that's why people are a bit worried about the changes that's happening.
Yeah.
Especially the new buyers are happy. Some of the old investors are not happy because expected property prices will decrease in 1 or 2 years.
Yeah.
So basically, it's quite a bit of quite negative environment at the moment after budget. Business people are worried because the trust structure they're using no longer quite useful like it used to be.
Sure.
Especially even they can distribute within the family trust each other, and they can get the maximum tax benefit after fate. But after this budget, you have to rework those strategies and see which way going forward will be much more beneficial.
Sure.
But I think they've given time till 30 June 27 with the existing structure, and from July 27 the new structuring will start. And so we have about time of year and we structure the businesses and see what best suited for them, and then work through with them.
This episode is sponsored by Finsol Insurance, where we help families protect what matters most: your health, your loved ones, and your lifestyle. Life is unpredictable, but your financial security shouldn't be. So, if you're a parent, a homeowner, or just someone who values peace of mind, make sure that you are protected with the right protection. Use the link below to book a strategy call and take the first step towards securing your future. Thanks for explaining that, but what are the action items? Like, is there any quick tip that people should be mindful of or look into it? Or
There's no quick fix to this. Unless it's been there for decades.
observation, right?
It's gonna take at least year or two to even revert the strategy. So sometimes if you have your license holder, say if you are a real estate agent, you got license under your trust, then if you want to change your structure to company, you have to reapply a licensing, you have to take it under the new company, you have to take insurance in the new company, you have to get your landlord to update your lease. Sure. There's lots of elements attached to restructuring the whole thing.
Right.
So there's no quick fix to anything. So you'll have to each one has to see as per the individual circumstances what are the disadvantages, what are the advantages of the whole changes, and then work through it and see how to work through. Even as an accountant, we are still observing all these things to see what strategies we're gonna implement in future to make sure tax minimization can happen in a legal legitimate way. But at the moment, there is no quick fix. And there's no real one answer. And I think also budget hasn't gone through the parliament yet. So usually we wait for budget to go through parliament because sometimes at the end they are saying they might give some concession to tech sector. They might extend that CGT concession to some other people as well. So I'll say to people, let's wait, let it go to the parliament and then work out a strategy. Sometimes what happens is you try to rush into scenario and you say, hey, I want to change the structure. If you change structure, if your property within your family trust, then you end up paying double stamp duty. Okay. And then, the laws could change next year. So basically, you say just patiently wait, see how the environment going on, and then check with, your professional advisor and then work through the scenarios.
Sure. No reason to panic because there's definitely a lot of panic that it feels like is happening.
I mean, look, nobody likes to pay taxes, If you are a good businessman, it's quite simple scenario. You legitimately, whatever money you want to say, don't only give it to government. So with the new system, say capital gain used to be at least 23.5%. Now it's minimum 30%. So you're gonna end up paying that extra taxes.
Yeah.
Also, there is other few laws that are changed. So basically, people are end up gonna paying 47% tax on their trust income, passive income they're generating. So obviously nobody likes to pay that extra 22% or 5%, 6%, whatever it is. So that's gonna create panic. But as I said, you have to follow law.
What are the goods, according to you, that you have seen from the budget? Any positives?
For young people, it's pretty good budget. There's quite young people excited about it because they expect property prices to go downwards. So now their affordability gonna increase. So it's pretty good for those people who's looking to buy their first home or those kind of properties. And for new properties, the scenario is the same. Negative gearing is allowed. So young families who have their personal home, they want to buy investment properties. For them, it's pretty good scenario. They're not happy with the increasing price on a year-to-year basis. They can enter the market, balance out the whole scenario.
So tell me, I've got a lot of clients. Let's say if they are holding one owner occupied property and they have got two investment property already, should they be looking to enter the market to buy a third one, or now should they just be happy with what they have?
Look, it depends on the yield and those things. On each property, you have to work out your scenario. If its property is negatively geared, even though say tax deduction is not there, but if you expect capital growth into those properties, at the end of the day, you have to look at business scenario. When you're gonna invest, whether you're gonna make money out of it or not in 3 years, 5 years, 10 years. So if you're happy with investing, making good profit, it's just that you're not gonna get tax benefit out of existing properties. It's the scenario in most of the countries. So basically, just work out your business scenario and make a decision accordingly.
And also, I feel it's a good time to upgrade for people who looking to upgrade their owner occupied property.
Definitely, it's quite good strategy because the existing home you can still negatively gear. So you can move out of an existing home and you can go into your another personal home and then work out that strategy is still quite active. It will work out quite well. So basically, from a tax perspective, at the moment, especially in Victoria, that's one strategy. Another strategy is you can build your own home because it's still tax free. You can live in there for a few years, and then when you sell it off, there is no capital gain tax. So both two strategies are still very active. People can definitely implement those strategies.
What are your thoughts on SMSF?
SMSF is a good tool to invest into properties and make it work as far as you got a decent balance in there. Sometimes we see people got 70, 100,000 and then they start SMSF.
It's too much, too less.
But it's too less, with property you can get it for 500, 450, and then there's admin cost attached to it. So as far as again, if there is a growth expected, if you're gonna make money out of that property, then yes, definitely do it. But do your numbers first and then work out whether it's worthwhile or not.
But from the taxation point of view, nothing has changed in SMSF structure, right?
No, SMS is still very good tool. If you buy a property, you sell after 12 months, only you end up paying 10% tax. So basically, it's still one of the best vehicle to invest in long term.
Fair enough. Any changes in the concessional contribution cap for superannuation, SMSF?
No, still the same.
Still the same.
Yeah, I think from next day it's changing. I'll have to check.
Okay.
But they would try to index that concessional contribution cap from next year.
Okay. But you can still pull forward 3 years if needed to.
If your balance is less than 500,000,
Okay.
then basically you're allowed to go back 5 years
Okay.
and basically consistently contribute. So people who wants to contribute before 30 June is definitely they can go on their MyGov account and they can check how much contribution they have left. Only thing is they just have to double check their super bond balance is not more than 500,000.
Before the contribution, but they can.
1st July last year.
Okay.
So basically, as far as their balance is 1st July last year is less than $500,000, they can use that last 5 years of super balance leftovers and then contribute it all together.
Sure. Because I think I've been seeing a lot of people investing in property through their SMSF. Like I think the last 2 years, that's pretty much most of the chat that has been around.
I think it's good definitely, as I say, from tax perspective and also from asset protection perspective. That's one of the best thing you can do to yourself. We say if you're planning to do properly, then by the time you retire, you should have at least 3 to 4 properties in your super fund. So that way it becomes a pension income. And the good thing is when you're going to say it, there won't be any capital gain tax.
Sure.
So basically, if you work smartly and you pay off your first property within 12 to 15 years, then basically you can buy another one that will take another 10 years to pay off. And then third property will take 7 years.
Right.
So basically, by the time you retire, you can have at least 3 property.
That's like a time cycle sort of.
Yep. Should pay quite big money there.
Well, there was a confusion that some of my clients had was the new implication is coming from 1st July 2027, right? From the negative gearing.
Yep.
So they are thinking if they buy a property today or before July 2027, they can get negative gearing. But I think there's a only for 1 year, right? Because
After budget day.
yes, so any property bought after the budget, which is 12th of May, they will only be able to claim negative gearing for that 1 year. It's not that before 27 July they can buy whatever and it will be claimable for life.
No, that's not how it is.
Okay.
That's it, but how does that change people coming to you for financing? Like with all this change and chatter happening around negative gearing and everything, what is the sentiment out there?
See, I think again very good for first home buyers, property upgraders. So I'm seeing a lot of them. Investors are looking for good opportunities. So there are people who are sitting on a lot of capital, a lot of borrowing capacity. They are taking this as an opportunity as well to invest in the market because it's a buyer's market. So anyone planning to sell, I'm telling them if you can hold on, then hold on or be realistic in terms of what price you are going to get for your property. You're not going to get what you're expecting or what it was going to be. If you're happy to take a hit and if you have to sell, you sell, or else hold on to it because that property probably can get more negative gearing long term wise. It's still going to be better. It's just that, as Maulik was saying, the 2 years it will just take some time to settle down. But I think the demand is there, supply isn't there. So eventually everything is going to go up gradually. But I think it just will take some time to adjust to these new norms.
Okay. And it doesn't change the capital gain tax implications with any of these changes, right?
No, so what's going to happen is basically there's quite a bit of mechanism. We're waiting for budget to pass, so we understand how the mechanism is going to work. But technically, on 1st of July 27, you have to get the valuation of your property, and that gets locked in at that valuation. And from that point, you get indexation benefit. So basically, say you have this property, you wanna rent it out. After 10 years, you decide to sell.
Yeah.
So basically, say 1st of July 27, it's 50% discount method. And then from there onwards, it's indexation. So basically, whoever is investor, they have to kind of lock in their valuation as of 1st July 27. And from that point onwards, they're eligible for indexation. Before that, it will be a bit of discounted method. So we're still trying to understand mechanism how it's gonna work out. But from 1st July 27, there is no 50% discount. So only indexation method. So your tax level could be a bit higher. Could be there's that perception that you're gonna definitely lose money. It's not the scenario. I was really looking at the treasurer's interview, and he was rightly saying that if you hold property for more than 20 years, they will be better off under this new method compared to 50% discount.
Right.
Because say if you bought some property in 1990s you're selling it today after such a long time, you're still only getting 50% discount. But then if according to indexation method, if you got 3% CPI each year, then for 35 years, you would have to at least double it.
Good.
So you're probably going to end up having, benefit on your side if you're a very long-term investor. So basically, it's kind of, we'll have to wait and see.
So now there is nothing such as short term where you can make money within 2 years and leave the market. It's more about
I mean, you can still do money. The only thing is your tax bill is going to go higher. So that's the only disadvantage of it. So basically, the strategy still work as far as money you can invest. What I think is your partner will be, asking for more money.
Whether the trade-off is the facts or the growth in the property.
Yeah.
So
Yeah.
I also wanted to touch on the end of financial year strategies, again relevant to business owners. What is maybe the top 3 things that somebody could be doing sitting really right at the end of financial year?
I think also look at your super contributions as of now. Say if you got any carry forward concession limits left out, try to contribute as far as the cash flow allows. It's usually tax advantageous for high net worth people because they pay 47% tax and super pays 15% tax. So you got quite a bit of tax saving there. These other strategies are if you are a small business, then you can prepay a lot of your expenses. So that's sort of the other strategies you can try and implement. And again, look at your profit and loss, see what tax liabilities are coming in, and work out your tax bill now rather than next year May. So at least you can plan things. You know what kind of tax bills coming in. You can work out your cash flow. So basically, these 3 things are very important. So basically, what cash flow these days, it's gonna be the key factor out of all to survive for another 2-3 years in the business, especially given sales are going down, income is not performing well. You have to worry about your cash flow, work it out before June, and see how you can plan things.
Sure. It also, I think, payday super gets implemented 1st July to
First July 6. Yes, that's correct.
So that also will have a big impact on
That's gonna have quite good impact on everybody. So they have to pay super together with your pay. I mean, it's good and bad. So it's good thing you don't have any extra outstanding liability sitting. So once it's paid on the same payday, it's done and dusted. But then you don't get to use that cash flow for 3 or 4 months after the quarter finish.
Yeah.
So basically, a cash flow is gonna be quite tricky. And ATO is going quite aggressive about a lot of other things, like they expect you to have trust resolution passed before 30 June. There is another clause with the trust distributions called Section 100A, where say if you're distributing money to your older kids, they expect it to make a physical distribution of monies before 30 June. So basically, those are the things you should check with your professional consultant
Sure.
that you must do before 30 June if you want to get benefit in your tax returns. These days, you can't do it after year is finished,
Right.
and then basically try to work through the numbers.
It happens commonly.
Yes.
what is your take on interest in advance? Are you seeing more people doing it?
Look, again, people wants to do it, but cash flow kind of restricting them with doing it. A lot of professionals are doing it regular basis. So basically, it's quite good strategy for them because they have got cash flow available to themselves. Exercises, I would say definitely do it.
Because again, a lot of people are not even aware of that concept. What does that mean? Like mom and dad, investors, they don't know what that means, or that don't even know what, and is there something that exists?
It's on a cash basis, so you can claim it in the year you pay. So basically, if you pay like 12 months of interest in advance, you're allowed to claim it.
Claim it. And under what circumstances people would do it? Let's say if they're going to sell a property next year or something, that is a trigger that they should definitely do it before you do something like that.
It's purely from tax perspective. If you're gonna get tax benefit, then just do it and claim it in your tax return.
Got it. So as long as you got the money to pay the interest in advance, you get a cheaper rate as well
That's
from the bank, and you're saving from both sides. Right?
Yep. That's quite simple. If you got the money, do it. If your cash flow allows, if your cash flow doesn't allow, don't worry about it.
Fair enough.
And what would be important for, like, especially in the financial year for someone who is a high income on a PAYG person, not a self-employed person, but has multiple properties? Anything that they should keep in mind before we get close to it?
Tax wise, nothing much they can do as such, there's not many opportunities other than, going through the numbers, making sure the deductions are maximized, get the depreciation schedule done if you bought a property during the year, make sure all the receipts are saved for accountant to do it at the end of the year. But I think for POG people, I'll say make sure you got a good strategy in place, because mostly there's a misconception say, hey, let's buy property, negatively gear it, and then get the tax advantage out of it. But when they go back 5, 10 years later, and then they work out, and then they actually end up losing money because there is no growth in the property.
Right.
So I think it's usually around this time of year, good time for them to rethink their strategy to see whether the growth cycle is there or not. Especially say in Victoria, whoever is invested, interest rates are about 6 to 7%. Land tax bill could be between 1 to 2.5%. And then you got rates, insurance. So overall expenses are about 10% of your property holding cost. You get rental yield of 3 to 4%. So you're negatively geared by 6 to 7%. Out of it, 47% ATU is gonna reimburse it to you. But when you're gonna sell these property, the depreciation gonna get clawed back.
Sure.
And then basically the growth has to be at least 4 to 5% in that property for you to make money.
Right.
But if you just purely not doing anything, you just bought it 5 years ago, you're just sitting there relaxing, those days are gone where you expect property to just keep growing on its own without you doing anything. So before this June is always good time to reconsider strategy for next year or next couple of years, to see which property you should keep, which one you should sell, and whether you should invest in residential, commercial. Those kind of talks are usually good around this time of year.
There is also another thing where people are talking now, you should buy properties under the trust or a company name instead of personal name for your investment purpose. How does that work?
So I think that strategy can work for business people, but again with these new trust law changes, their strategy might not work.
Okay.
Because say before, what used to happen is in between trust to trust distribution. So you got trust A, you got trust B, and trust C. You got three properties. One property is positively geared with 100,000. These two properties are negatively geared with 50,000. You could easily distribute this 100,000 gain into this other two trust. But now with the new changes on this 100,000, you have to pay 30,000 tax, which you're not gonna get back, and you can still distribute money to other two trusts, but you're losing that 30,000 benefit. So basically, those strategies you have to reevaluate, reconsider, saying it's worthwhile to still push those strategies.
Because negative gearing doesn't apply for a company loan, right? So, is it like a lot of bias agent and a lot of people are talking now, buy property in a company name because negative gearing is not there. And whatever loss you're going to make, you will be able to claim it at the time when you sell it from the capital gains, technically. Is that right? So, is that still what you would suggest to do, or is there a better way of doing it?
There's a good and bad about it. I mean, it's a company tax that is 25%. So if you buy a property in a company and even you sell it, you pay 25% tax. But the problem is when you want to say you got a profit of 100,000, you pay 25,000 tax, you left with 75,000. So you have to reinvest that money within the company going forward. Then you don't have to pay any extra taxes. But say after some time you want to withdraw that 75,000 for yourself or personal use, then you'll have to withdraw that money. And then what happens is that income gets added to your personal income. So basically that 100,000 company profit was there, get added to your income, you get 25,000 credit. But say if you're to marginal tax rate of highest, 47%, and you end up paying extra 22%. So basically, as far as you're aware of this scenario, because a lot of time what happens is people go in, invest in company, and then after 5 years they say, hey,
I want to borrow equity.
use that money, or want to buy my personal home with that money, and when they withdraw they get a big tax bill. So they say, hey, why I have to pay extra 22,000? While with trust scenario, even though it's 30% tax, but then you get a indexation benefit discount on your previous properties, but it's still capped at 30%. There is no more taxes coming for you later on. You're shorting out your taxes in the same year.
Same here.
So basically, it depends on what people want. As far as you wealthy, you don't gonna need that money for personal use. You could just keep reinvesting in your company. But if you, kind of young family, you might want to upgrade your home in 5, 10 years time with that money. then trust still could be good
Because I'll
strategy.
tell you the strategy for a lot of buyer's agent, they tell their clients that, you will buy, let's say, 3 properties in 1 year or 2 years. They want to buy each property in a different trust, a different vehicle, and they want to then show that trust or company is profitable so that liability doesn't come on the second one or the third one. What are your thoughts and what are your recommendation if someone wants to do that? Is it advisable, or is there a, like, because the buyer's agent will tell from their point of view, which is like they want to sell more properties and make more money, yeah, but from the client point of view, I want to see if there's any suggestion, any feedback, anything that they need to be mindful of.
No, I think it can be good strategy, especially say land tax has got a threshold based on the amounts. So if you say put a one property into one company, if you buy another property in the same company, then they will even pay higher rate of land tax. So basically, it's always good idea to check with your accountant or yourself with the land tax calculator on straight on your office website. You can go and easily check. So basically, you consider say if you buy one property 600,000, other one 600,000, what's the land value, and how much extra land tax in the pay if you buy in the same company. So the strategy could be worked out quite well. Also, a lot of time what we come across is if you buy within the same company, so if you go with ANZ Bank and then second property you buy in the same company, you go with net, and then they both want first right over the company. So the banks fight and then you're stuck in the middle.
Yes.
You don't know what to do. So it's a good idea to buy it in a separate companies as far as the admin cost is justifiable.
And would you still suggest a corporate trustee, which is a trust and then a company as a trustee for the trust, or would you just buy under a company with individual directors?
I think that's again it depends on the each individual. If you wanna keep reinvesting, then buy under company with individual director shareholder. But if you want to withdraw money later on or give it to your family as a gift or something, then still trust is
Trust is
a
better.
better vehicle.
And at the moment, most of the properties are like holding companies, and the rent is not enough to cover the expenses. Someone's doing Uber driving or something. Can they take money in that trust, in that company, and kind of to make that company profitable? Or is there a way to generate income for a trading entity?
Technically, no.
Okay.
So basically, it has to be engaged in an income producing activity. That companies it has to do something of its own to make that company or trust profitable.
Okay.
So basically, it has to be engaged in some kind of income producing activity.
Fair enough. Or else because they won't be able to prove that, oh, this my company and my property is self-sufficient.
That's correct.
And then that's a liability that you have to expense it out, which
That's
will impact your borrowing.
Yeah. So that's you have to work out. Again, when you borrow money, you have to have strategy in place how you're gonna make that property positive because there's less stress on yourself and yes.
Yes.
So basically, there's a reason banks ask for it. Yes. They don't want person to get stressed out. So
True.
basically, as far as they work out in advance, they make it through. Then I think that strategy can work. But they just have to make sure things.
Yeah, because they think, oh, it's very easy to. I was like, how is it possible when the rent is 4% and you're paying 6-7%?
That's correct.
You will be in a negative thing. So you have to expense it. It's not that you buy in a trust and you can get away with it.
That's correct. A lot of people get caught in middle, and then after a year or two, they realize, what they've done, and then it's too late, and a lot of people end up for selling those properties.
And I think a lot of the time, also what they do is now, I think there's a concept of dual occupancy where they are able to rent out the house to two different families, and they get more rent from it. And then the rental yield all of a sudden from 3.5-4% becomes 5.5 6%.
Yeah, roaming house is very popular these days.
Yeah.
Even with students and those ones, it's quite cool. You get a possibly get property straight away. So all the possible scenarios are there if it's working for them. Why not?
Fair enough. What are your thoughts on commercial properties and commercial transactions? Are you seeing your clients, because you've got a range of clients and you've got so many people coming to you, Maulik, I need to create a company for a company to buy something else. So what are you seeing more? Where are people investing? Are they still investing in shares? Are they investing in properties, commercials, or putting money
Because
overseas?
there's no changes in the rules for commercial properties, so it's still the hot favorite cake for everybody that they want to eat. So we still love people want to go into commercial, but then there is a lot of risk attached with commercial cycle that you go in. So with commercial property, there's a vacancy rate is very high. compared to residentials. So your cash flow has to allow for those commercial investment. Say if you buy a factory or warehouse, if it doesn't get rent out for 2 years, you have to allow for those cash flow issues. So people are going ahead and buying those commercial properties because they can still negative gear those things. But my always advice is make sure your cash flow is very strong to support you while that property gets rented out. Once it's rented out, everything is bad by the tenant other than interest or maybe land tax. It's quite good investment. You should allow for, the adjustment cash flow. We see sometimes takes 3 or 4 years to rent out commercial property.
Yeah,
So as far
it's
as your
longer.
cash flow is quite strong, yeah, go for it.
I also see a lot of people investing into commercial through self-managed super funds also. Is that something that is recommended? Because if that's the case, and if it is not being rented out for so long and this vacancy rates are high.
Again, cash flow. Say if you buy from SMSF and then you got no capacity to put concession contributions within your self-managed super fund,
Yeah.
there's a good chance SMSF has to force sell as up those properties. So you have to look at your cash flow situation first and then see whether there is a sufficient balance or sufficient cash flow to put money every year and then purchase it from that sector.
But are we here in finance for SMSF, like commercial property?
Yeah,
too?
yeah, yeah.
They do, the banks are okay
Very
with
easy.
that.
Same as Resi, no issues. And a lot of the times they buy with lease in place, 5+5+5, where there's an option to renew. Sometimes the tenants are strong, so then the risk is less that the property will be vacant very little amount of time, if any. So uh, you can't do development construction under SMSF, but you can buy off the plan brand new ones, which sometimes just makes it harder to find a tenant. But as existing commercial property as well, people buy with there are tenant already in there, and there's an existing lease in there which they're taking over, and if the tenants are strong, then it's a good thing. But if you're not sure of the tenant or they're going to vacate in the next couple of years, you're better off making sure that what it's going to happen after that before you enter that contract.
Sure. But the financing is the same. Like they don't need higher balance. They don't need to keep more money aside.
No, depending on, again, commercial is a very wide spectrum. So there are like offices, retail, warehouses, childcare, hotels, petrol stations, so depending on the specialized property, certain properties the bank can give more loans, certain properties they are kind of more risky, so they will give a lesser loan amount. But yes, commercial properties, it's as good as bank happy to give loans under SMSF or under personal names as well.
Sure. Thank you for sharing that. Maulik, I wanted to ask you about AI with the ATO, right? It is using more AI, more data matching than ever before. What does that mean for business owners, investors?
Now, if you look at last two budgets, they got really good funding for the AI implementation and a lot of resources they are allocating towards it. So if you got a luxury cars, you got even high-end properties, you got a very expensive kind of yachts, anything that comes in, ATO's got data matching with your insurance policies, including life insurance policies. ATO's got data matching with all these lifestyle uh, things that you're doing. So basically, even what they are doing is, because before it used to be a whole manual process, somebody has to go and check manually whether these guys are high net worth earner, how much income he's declaring, his entities are how much declaring income. Now with AI in there, it becomes a lot easier for you to target all these people. With AI can easily pick up exactly who they want to target, and then basically they can start review or audit accordingly. So it has put so much resources behind that basically it's very getting difficult for people to hide away taxes or those things. If they got a lifestyle, they have to show it you how they're gonna support it.
Right. So no more 50,000, 100,000 income and then having.
No, it was very aggressive with those things these days. Yeah, I mean, it's kind of makes sense as well. Say if you got your car repayments, you got your house repayments, you got your investment property repayment. If repayments are 500,000 in a year, how can you afford it with 100,000 income?
Yes. Yeah.
So or basically ATO, what these days the system is picking up as well. If you got an income in company for $1 million, you pay 25% tax, but that dividend didn't flow through to your personal income, but your lifestyle is that you're gonna use that money. So ATOs pick up a lot of cases where there is a D7 issue. We call it technically Division 7A loans, where director has withdrawn money from the company, but hasn't declared in his personal tax return. So basically, if you don't have proper arrangement in place for those things, the whole money becomes untrained dividend to the director, and then they have to pay tax at marginal tax rate in their personal tax return. So ATO with this AI, they're targeting a lot of these kind of scenarios as well. Yeah. So basically, people are very careful with how they work out.
Fair enough. Any unintentional places where people could be missing out on, not because they are dodgy, but they could be busy, they didn't know, or anything that people can be more mindful of certain things so that they don't get caught by the it.
I think mostly we see people get lazy, especially around the structuring. Say they set up structure 10, 20 years ago when they started business, and they never kind of review it. And that makes things quite bad for them, because those are the things, people are not aware of it. They just either get lazy or they don't get right advice. You have to keep reviewing your structure now and then, and that will save you legitimately for a lot of taxes. But if you got in a bad structure, then basically you are stuck with it. There's no option available to you.
Fair enough. That's true.
I think again, like how we review home loans and insurances, I think it's Maulik said it should be reviewed your business structure from the taxation point of view or tax planning point of view. If you want to grow, if the business is growing, I would rather go to the accountant beforehand than going at the last minute to figure out if there's a way to save anything or a better way to do the whole thing.
Yes, no, absolutely. That's
So those are common things we see every day in, day out. Lots of time. Even people are running a business on the sole trader for 15, 20 years.
Yeah.
They won't even know. And then they have to, they say my tax bill is too much. I don't know why.
Fair enough. The other question that I had probably applicable to both of you in terms of a structuring point of view. I see again in my line of work, I see people coming with so many properties, have big businesses, a lot of turnover. Somehow they have completely missed the conversation around protecting it. Like because either nobody's spoken about it or they forgot about it. I don't know. Like how does that come into the picture? Is it something that you probably would recommend down the line when they had enough money, or how do you see it?
Yes, so basically we try to, when we do the tax planning for the year end, we always try to review those things, how the assets are protected. But we say, to protect the asset, there has to be good amount of assets.
Yeah.
Otherwise, you might end up costing a lot of money to protect those assets, which is, always it's not that much amount there to justify the cost attached to those asset protection strategies.
Yeah.
So I think as far as people got good amount of money, we always try to advise them about asset protection strategies and see how they can save money or they can inherit properties or their money to next generation.
Yeah.
Without having much stamp duty or capital gain or those kind of scenarios.
Yeah.
But again, we have to work with lawyers to make those strategies in place, and then clients have to be happy with
That
especially
is
that
that
money
with it.
attached to it. So lately, just a couple of weeks ago, I have a client. She's a doctor, about 91 years of old. So we were advising her with a lawyer to set up testimony trust for the kid. Luckily, we didn't set it up because of budget now charging 30% tax. But then as soon as we told her, she goes, "How much you guys gonna charge?" Yes, I think as far as client is happy to pay for the advice, then there's different strategies available to implement and at least have a smooth intergenerational transition.
Do you look at, I think in the super, you would suggest them after a certain threshold to take private health insurances, or
As soon as they expect their income to go 194,000, you always say have private health insurance.
and that has to be done before a certain age as well, or
If you do it before 30, then there is no loading.
okay,
Otherwise, for each year you don't have it, you have to pay about 2% loading
fair
on the
enough,
premiums for those time.
makes sense. And for the SMSF structure, if I think with the insurance thing, if they have an SMSF thing, is that the rollover can't happen before or after? If they've got an insurance in your super, and then if you want to set up an SMSF,
So if you roll out completely from an industry super fund into a self-managed super fund, any insurance that was attached to your industry super fund would get automatically cancelled just because the account no longer exists. So a lot of time people would either keep some balance in that industry account just so that the insurance doesn't lapse, or I think the better strategy is to have a separate insurance policy that is not tied to that industry fund and can be paid from the SMSF when you're managing one account eventually.
Hmm. So that is still an expense in the SMSF
Separate.
facility. Okay.
If you can claim life insurance and TPD as a deductible expense in your super fund.
So it is a tax, okay, deductible expense.
I think before I let you go, I just wanted to, one question that I had is that I commonly see people that, okay, I want to do SMSF and I want to invest in property because my friend is doing it, because somebody, and they have not thought about it. What are three common mistakes that you see, or misconceptions that they like, or they should be careful about creating an SMSF because it's some plans, there's a lot of things involved with it. So
So I think about 2 or 3 years ago when the statistics came out of every 5 SMSFs get set up, one of them after 2 to 3 years gets rolled back into public super. So that's almost 20% of the total super fund gets set up. 20% gets clawed back, and they put money back into public fund because they haven't got time to either invest money or buy property or work out what they're gonna do with that money. So our advice is always make sure you understand the cost attached to setting up SMSF, and then the ongoing cost of attaching that self-managed fund, the compliance requirement. You got education to yourself. There's a ATO courses available online. Sure. So you can go and do those courses as well if you don't understand how the SMSF works. Second thing is, once the setup cost and everything is understood, when you will get time to invest your money in super. So if you want to buy a property, before you roll over money from public fund, decide what suburb you're gonna choose, whether the budget you have, the approval, loan approval you might gonna get, which suburbs you're gonna fit in, because we don't want them to do this exercise after they roll over the money.
yes.
So as far as they do this exercise, they know they can buy a property within 12 months. Then only they should roll over money in a self-managed fund account or start the process of self-managed fund. Third thing is, again, once you buy property in SMSF, you can't just go to sleep and say let it go on its own. Again, and rework your investment strategy and say, is that the best place with my money putting there, or I can be sell this property, make some money, and then reinvest somewhere. So those are the three things people have to be careful with self-managed fund, and make sure it's invested at the right time with right property, and always
Someone buying a property residential under SMSF sold after 5 years, standard 30%, 10%
so
tax.
15% tax is there, and they get 1/3 discount. So effective tax rate becomes 10%.
So even after now or after 1st July, same, nothing has changed, right? So even if they see that property has done well in SMSF, sell it, then they can buy something else as well. The tax bracket is very less.
That's correct.
So if you want to make more money for yourself from the taxation point of view, forget about negative gearing. You still buy under this SMSF vehicle and keep reinvesting or restructuring or reportfolioing your properties and keep doing that. For me, like, I think I would rather look for properties 700 or 1000, let it grow. I'm sure that that segment market is going to grow very quickly because of first time buyers and investors. So after 5 years, sell it for 950, then buy again something else for 800 or 700,
Well, that's a good strategy. Only thing is, I'll just remind our high net wealth customers. So there's new law coming in from 1st July 26 called D296. So basically, what it's doing is, if you got a balances between 3 to 10 million, the tax liability that you're gonna have, you have to pay extra 15% tax on your earnings in super. If you got balance more than 10 million, then you have to pay extra 25% tax on your super earnings in your personal capacity. So basically, if you got a high super balance, you rather work with it and see if it's really worthwhile putting money in superannuation or not. Because up to certain level, it's okay to have that super strategy. But once you become high net wealth and really good within your self managed fund, you're gonna cap it. You won't be able to do it any longer.
Fair enough. And that is starting from 3 million, you said? Or okay.
So, but then you gotta think when you're gonna retire. See, this threshold's not gonna change much.
Huh.
So basically, if you have a couple of million now, you could either stop and let it grow on its own. Here in 10, 15 years time, you're gonna be able to breach it.
More.
And instead of 15%, you might pay 30 or 40% tax. So basically, you either invest through company and pay 25% tax. So basically, depends on your super
Fair
balance and
enough.
how good you perform.
So I think again, if I got one thing is obviously everyone's in a different situation, different life cycles, different stage of life, whether to buy an investment, whether to upgrade, whether to buy under company or a trust or under SMSF. Tax planning is very, very crucial, and that legal advice, because as a broker I don't even know half of the things, so I can tell them from the bank which bank is good or who's giving us what rate, but I definitely can't go to that level of advice that as a professional you can give, so I definitely tell my client, might take a proper advice from your accountant how you want to structure it, and then I can work with your accountant to get that thing right. Because
Say last year I was discussing with one of my clients, and we saying, there are so many taxes, so many thresholds now. You will need to really go through every single minute details in such a good way that basically, you have to spend a lot of time behind it to make sure you don't get it wrong. Because see, there's so many things that going on. Basically, you don't know which ones you're gonna get it wrong.
True.
So basically, we say you got two options. You get a smart accountant or pack your bags and go.
No, absolutely. And
Essential because all of this has long-term implications. It's not you do it today and this. So it's so important to be on top of it and keep reviewing it and be in touch with someone who's good and help you grow.
and we can tell from our experience that every year I know that we'll have a chat, we'll have a discussion. Are we doing anything differently? What are we doing? How should we do it? This is what's happening, and I think that's very helpful what you tell us and what you guide us, because for us then it becomes okay. This is what we're doing, done. Because you're an expert, and we come to you to save taxes as much as possible and to do in the best possible structure. So that's the professional advice matters.
These days, even we struggling as an accountant, like they have made so many things.
Yeah, exactly. You need to be on top of so much.
That's correct. And then you have to think going forward as well. As if we, at the moment, we got some super funds with balance of 1.6, 1.7 mil already. So we're telling them, hey, stop here. Because you got a problem, you're 35, 40 years old. And then basically going forward, you're gonna definitely, because these are smart people, they're gonna perform really well with their investments. So if they're gonna keep performing well, then their partners asking for more money. So basically, they're gonna be very careful with those strategies.
Yeah, they can still do the same thing but in a different structure to save more tax. So it's all about playing smartly and using your knowledge to save tax. And that's what I'm sure a lot of the business owners and high net individuals will be doing already. They would have a army of accountants with them, if not one.
Yeah, no, I think, look, as I said, that's the important thing these days. Like to consider carefully what you're doing, what's your strategy, how you're gonna work through. If you go like previous days, hey, just one structure, I'll be there for 20 years, then you will pick top that's right.
No, thank you, Maulik. I think from our personal experiences that you have helped us in our business and our property journey in every single thing that we've done. So thank you for all the advice that you've given us and helped us grow.
No, again, from a personal experience as well, we really appreciate the journey with you and how you have helped us grow. It makes a big impact for sure.
Always pleasure.
No, thank you for your time as well and coming on this, because I jumped in on this thing because I had a lot of questions to ask after the budget and for my clients as well. So I told Priyanka, can you let me in as well? I would love to be on this one for sure. So thank you so much.
Thank you. Thank you, Hardik. Thank you, Maulik.
Always pleasure.